The Kenyan share market appears to have shrugged off pre-election worries to reflect continued growth. Analysts say 1.2% depreciation of the Kenyan shilling may reflect pre-election jitters as the country heads towards East African nations' general elections on March 4. For more, we are now joined by Einstein Kihanda, Chief Investment Officer at ICEA Asset Management out in Nairobi. So we go back to Nairobi live. And I was just going through the numbers and just trying to make sense of your findings. And what the general trend that I'm picking up is that the Kenyan fund managers, or to resist, most of the investors, pile their money into fixed income, neglecting equities. Equities then outperformed, and in terms of performance, we're getting a good performance out of the fund management industry. But you have to wonder really how much they had lost, how much an opportunity loss this was if they had moved their money more into equities than fixed income.
You're very right. I think one of the key observations that one makes about the Kenyan financial markets is the very high level of volatility. If you look at the scenario in 2011, interest rates increased sharply, and as a result, bond values declined significantly, and consequently, and also the equity market also dipped quite significantly. So I think the reaction in 2012 was to be a bit more cautious in terms of investing in equities, and therefore, as the market was improving, there was an additional investment in equities, but not as high exposure as you would have imagined. Particularly now, of course, with hindsight, if you had a higher exposure to equities, you'd obviously would have made a much better return than in bonds. But I think it's also a reflection of the volatility, and hence also the need for some element of caution with regard to exposure to equities.
Yeah. Was that overdone, do you think? Because I'm looking at the numbers there that came from Actuarial Services East Africa ACTSEV, where they say 65.6% of all holdings were in fixed income and 27.7% was in equities.
I think part of it also is, if you look at the survey that you're talking about, it also has to do with the pension fund industry, and the kind of limits that have been, regulatory limits. Although, of course, from a regulatory point of view, the exposure limit is 70%. But the other factor is also, fixed income returns also did well because of the interest rate environment. But as you say, as you've correctly put it, in my view, it was that underexposure was a bit, if you had an exposure of 50 to 60% in equities, with hindsight, you'd have done extremely well. But of course, as I said, there's also always the element of volatility that one has to look at. Because, for instance, if you had a similar exposure in 2011, you would have reported significantly negative returns for that particular year. So I think it's a balance between risk and return.
Absolutely, and of course hindsight is a very good thing. But let's try and talk about the future and move away from hindsight, because now overall equities constitute, then that was in 2012, they constituted 27.4%, and that was actually, 23.3%, that was actually down from 27.4%. What in your view would be the right allocation, if you want, in terms of equities, that spread between equities, fixed income and the other asset classes?
One, I think it also has to do with the specific investment portfolio, but I think in terms of if you're looking at growth, long-term growth, I would be looking at a much higher, equity exposure, closer to even up to 50%, because if you look at the historical returns in the markets, obviously the equity market has outperformed, the fixed income market. So I would be looking at a higher weighting in equities. With a view to long-term growth. But I think it's also important to emphasize the fact that in our Kenyan market, we also don't have significant. The universe of investment opportunities in terms of the listed equities is also not is also rather limited. So that has to go along with also and getting more listings coming into the market, so that we have a wider avenue, especially because the pension industry looks set to grow, particularly the reform process that is already underway happens. So I think it's also an element of ensuring that we have a wider array of investment opportunities in the equity markets going forward. So
one has to say, if these elections go off peacefully, like everyone has been saying, and like we've seen so far, given the debates of the presidential candidates and the general performance of the market now already this year, 10.7 up on since the beginning of the year, this market can only run forward, no?
Yes, I think on the ground, obviously, a lot of view and comparison have been made with what happened in 2008, and obviously it's a scenario that no one wants to repeat. And there has therefore been a lot of emphasis in terms of ensuring that there's a peaceful election. A lot of reforms have taken place in our country, including, first of all, with the enactment of a new constitution and strengthening the institutional framework in terms of governance. So on the ground, a lot of efforts have been made to try and ensure that we have a peaceful election. And I think also the foreign investors, a lot of investors are also watching to see what's happening. And I think looking at how the equity market has performed over the last few months, it's quite clear that and as expected, we have a peaceful election. I think the only way would be up for our market.
Before I let you go, I must ask you a question I've been asking the other commentators that I've been talking to on the show, and it's been, who is the better candidate for the markets going forward? Be it the shilling, be it the equities, or fixed income?
That's a very tough question that you're...
It's not a tough question. We're getting into this era where we are transparent and our leaders sit and shake hands, and therefore, you know, you don't expect that anything else happens to you after you tell me that Mr. Raila Odinga is the better candidate, or is it Mr. Uhuru Kenyatta?
I think especially in view of the fact, if you look at the opinion polls, the race is extremely tight, and I think in terms of the markets, on the one hand, we've got one of the candidates has previously served as a finance minister for a period of time of about 2 years, and has played his part in terms of ensuring the reform process.
Mr. Kenyatta.
I think in my view, just Mr. Kenyatta, and I think in my view the markets and I mean the outcome. In my view, I do not want to put myself in the corner at this point, but I think the market is actually anticipating whoever of the two leading candidates would win. I think would both have their very strong credentials in terms of the their abilities to ensure that we have a smooth transition. So I know I haven't answered your question, but I think it's
Einstein Kihanda is hedging his bets ahead of that election on March 4. We shall certainly be watching that outcome with a lot of interest from here in Southern Africa. Now, he's Chief Investment Officer at ICEA Asset Management.